All right, welcome back to the deep dive. Today we're jumping into the latest earnings call from VF Corporation.
Yeah, we've sifted through it all, the numbers, the commentary.
And the goal here is simple. Give you, the experienced investor, a quick professional rundown, cut through the noise, get straight to the key signals.
Exactly. Consider this your condensed briefing.
Okay, let's dive right in. Q4 FY25 snapshot. Top line, revenue was down 3%.
Right, which landed them basically right inside their guided range.
Okay, so they hit the revenue guide, but where did things, maybe look a bit better than expected?
Well, the real story, I think, was on the operational side. Operating income showed some serious strength, up 400 basis points year over year.
400, wow.
Yeah, and gross margin, too, a really significant jump. We're talking 560 basis points improvement.
And it wasn't just playing with margins, right? SG&A expenses actually fell.
They did, down 2%. So yeah, even with that revenue pressure they guided for, they definitely made headway on costs.
And that flowed through to the balance sheet.
It did. Net debt saw a pretty substantial cut, down over $1.8 billion compared to last year.
Which brought the leverage ratio down.
Down a full turn year over year. So real progress there.
That's key context, especially since they did report an adjusted loss per share for the quarter, negative 13 cents.
Right. So if you sum up those initial numbers, you've got revenue headwinds, kind of as expected. But the underlying narrative is really about operational tightening. Better margins, lower costs, getting debt down.
A mixed bag then, but maybe some positive signals underneath that top line figure.
Definitely. Signs of improvement, for sure.
Okay, let's unpack that a bit more. That $2.1 billion revenue for Q4, the down 3%, it doesn't tell the whole story for the fiscal year, does it?
No, they made a point of saying the second half of the year was actually flat overall.
Which is quite a shift from the first half where they were down, 7%?
Exactly. So some stabilization or maybe acceleration there. But the gross margin figure, 53.4%, that's really the standout.
Yeah, and how did they explain that big jump?
Well, a few things. Lower material cost helped, obviously. But they also stressed it was deliberate actions. Less distressed sales, cutting back on dump discounts, and generally managing inventory quality better.
And importantly, they called this structural, didn't they? Not just a temporary gain from cheaper cotton or whatever.
They did. They emphasized that they expect this improved margin profile to carry into FY26. That's a pretty critical part of their story.
Makes sense. And that feeds into the SG&A side, too, down 2%.
Right, and they link that directly to the Reinvent program savings. Basically saying if those cost cuts came in faster than expected and more than offset inflation and other investments.
So it sounds like Reinvent is starting to deliver tangible results on the cost line.
That seems to be the message.
Yeah.
And it all rolls up into the adjusted operating margin.
Which hit 1% in Q4. That's the 400 basis point jump year over year. And for the full year?
Full year improvement was 110 basis points. And they expect that expansion to continue in FY26.
But with a caveat for Q1.
Yeah, they did caution Q1 might not show that same pace of improvement. A bit of a breather, perhaps.
Okay, shifting over to the balance sheet health. Inventories.
Down 4%, but $71 million. But the bigger piece is that net debt reduction.
The $1.8 million year-over-year drop.
Exactly. Which gets leveraged down to 4.1 times at year end.
From 5.1 times last year. They're clearly focused on deleveraging. What's the goal, Ina?
Medium-term goal is to get leverage below 2.5 times. So still some way to go, but a clear priority.
Right. Now, free cash flow. That came in a bit light compared to guidance.
It did. $313 million versus the $440 million they'd forecast.
What was the reason?
They explained it as mainly a timing thing with working capital. Apparently, they prepaid an item in late March that usually would have hit in early April.
Ah, okay. So the underlying cash generation wasn't necessarily weaker.
Doesn't sound like it.
Yeah.
And they actually projected that operating cash flow and free cash flow, excluding any asset sales, should be up year over year in FY26.
Which is obviously crucial for that debt reduction plan.
Absolutely. And all these improvements, the margins, the costs, the cash flow focus, they keep tying it back to the Reinvent program.
Right. They mentioned getting over $300 million in savings already from phase one.
Yeah. And seeing early benefits from phase two now, which has a much bigger target.
What was it? $600 million additional operating profit?
That's the number, yeah. Split between more SG&A savings and gross margin uplift.
Yeah.
They sounded, pretty confident that this program is really reshaping the business foundation.
Okay, let's get into the brands then, because that's where the revenue picture gets particularly interesting, especially Vans.
Yeah, Vans, their biggest brand. Revenue down a significant 20%.
Ouch, that's a big number. But they broke that down, right? It wasn't all just consumers walking away.
Correct. Management attributed about 60% of that decline to, quote, deliberate strategic actions.
Which means things like?
Pulling back inventory in China, closing underperforming stores, both their own and some wholesale value doors, and generally doing fewer distressed, heavy discount sales.
Yeah.
Basically cleaning up the channel.
Okay, so 60% is strategic cleanup. What about the other 40%?
That, they said, was down to softer direct-to-consumer traffic. So while the cleanup might be needed, that 40%, getting people actually buying, that feels like the core challenge.
Right. Did they point to any green shoots amidst the cleanup?
Some. They mentioned sellout trends were flat to up in the cleaner, non-value wholesale channels, and even saw double-digit growth in some key accounts.
And the turnaround plan, new leadership, new product.
Exactly. Focusing on talent, product innovation, they highlighted the super low pro shoe doing well with women and youth as an example, elevating the marketplace and better marketing.
Okay, but the key takeaway for investors is the timing, right? These deliberate actions are going to keep weighing on Vans' revenue for a bit longer.
Yes, that's crucial. They expect these headwinds to continue through Q1 and Q2 of this fiscal year, FY26. They see it fading in Q3 and being gone by Q4.
So we should expect more negative Vans numbers in the near term, even if the underlying strategy is working?
That's the expectation they set. Volatility ahead for Vans.
Got it. What about the other big brands, the North Face?
The North Face held up well. Revenue up 4% globally. DTC was particularly strong, up 9% globally, double digits in the Americas and EMEA.
What categories were driving that?
Outerwear and footwear were standouts. And they mentioned a strategic push towards becoming more of a four-season brand.
Oh, okay. And Timberland?
Timberland had a really strong quarter, actually, up 13% revenue.
13%. Wow. Both channels.
Both wholesale and DTC up globally. They benefited from fewer discounts, which helped margins too. Mentioned momentum in key products like the classic 6-inch boot and things like Stone Street and Mount Manson. Plus, U.S. search interest is apparently strong.
Interesting. Okay, looking regionally then, how did the different parts of the world perform?
APAC was up 2%, but America's down 5% and EMEA down 2%.
And the UC-MEA decline was partly intentional.
That's what they reiterated, yeah. A consequence of pulling back on promotions to help protect those margins we talked about earlier.
And across channels overall.
DTC was down 3%, wholesale down 2%. Again, it ties back to those deliberate actions, store closures, pulling out of some value channels, impacting those numbers.
Okay, and management's view on the overall brand portfolio, happy with the mix?
Seems so. They express satisfaction with the current lineup and how it fits their strategy.
What about the store footprint, particularly for Vans after those closures?
Yeah, the global Vans store count was down about 8% year over year. Management feels like the, quote, heavy lifting on the major closures is mostly done now.
But they'll keep tweaking.
Oh, yeah. They said ongoing optimization, closing, opening, remodeling based on ROI will continue across their entire store base, not just Vans.
Right. Now, let's switch gears slightly. Tariffs. There was talk about the new 10% incremental tariff on U.S. imports. How exposed are they?
Actually, their sourcing profile looks relatively okay here. They said less than 2% of their U.S. finished goods actually come from China.
Oh, really? Where does most of it come from?
About 85% is from Southeast Asia and Central South America. The top four are Vietnam, Bangladesh, Cambodia, and Indonesia.
So direct China exposure is minimal, but there's still an impact, right?
Yes. The estimated unmitigated sort of full-year impact is around $150 million.
Okay, and how much of that hits this coming fiscal year, FY26?
They expect about 65% of that, so roughly $97.5 million to hit in FY26. And it's weighted more towards the second half of the year.
And their plan to deal with it, they can't just absorb $100 million?
No, they laid out a mitigation plan. It involves internal cost management, shifting some sourcing strategically, and using pricing actions where they can.
And they sounded confident they could offset it.
Quite confident, actually. They talked about fully offsetting these costs and even framed it as a chance to, get more agile and improve cycle times. We'll see.
Okay. Turn to the outlook then. Did they give full year FY26 guidance?
No, not yet. Holding off on that for now, likely because of all these moving parts we discussed.
Makes sense, but they did give Q1.
They did. For Q1 FY26, they expect revenue to be down 3-5% on a constant dollar basis.
And profitability.
They're forecasting an operating loss for Q1 between $110 million and $125 million.
Oof. But margins?
Gross margin should still benefit from fewer discounts and promotions, SG&A expected flat to maybe down slightly. They also mentioned forecasting first half FY26 revenue overall to be slightly below the second half of FY25.
But importantly, they still expect operating margin expansion for the full year after Q1.
Yes, reiterated that expectation, along with increasing free cash flow year over year for FY26.
Got it. Any other forward-looking points?
Just to mention that the effective tax rate is expected to creep up over the next year or two. Global tax changes, geographic mix. But they said minimal impact on actual cash taxes paid.
Okay. And debt management, still top priority.
Absolutely. Reinforce that goal. Get leverage below 2.5x.
They have that euro note maturing soon, don't they?
March 2026.
Yeah.
500 million euros. The plan is to pay it back using free cash flow and tapping into their $2 billion revolver if needed. They sounded confident they can handle it and keep paying down debt overall.
And one last time, on those gross margins, they're sticking to the structural improvement story.
Very much so. Emphasize that heavily. Key to their profit recovery narrative going forward.
Okay, let's pivot here for a moment.
Right.
And time for our regular disclaimer. This is not financial advice. What follows is purely a hypothetical exploration, a speculative trade idea based only on the earnings call information we just discussed. It's for illustrative purposes only. Do not take this as a recommendation.
Definitely not advice. But okay, purely as a thought experiment, based only on this call. One angle someone might consider exploring could be potentially a short position on VFC equity.
Interesting. Go short. Why that direction, given the operational improvements they highlighted?
Well, while management painted that picture of cleanup, balance sheet repair, and confidence, the elephant in the room is still that significant revenue weakness, especially at Vans.
And the timing you mentioned earlier?
Exactly. Those deliberate Vans headwinds are guided to hit hard in the first half of FY26. Then, just as those might be fading, the bulk of the estimated tariff impact arise in the second half.
So you're layering headwinds throughout the year.
Pretty much. It feels like there's quite a bit of execution risk stacked up. The speculative bet here is basically that the market might be, perhaps, a bit too optimistic about how quickly and smoothly the Vans turnaround happens.
Or maybe underestimating the tariff challenge.
Or that.
Oh.
The idea is that maybe those structural margin gains aren't quite enough to fully offset the top-line pressure if things get bumpy, or if passing on tariff costs via pricing proves harder than anticipated.
What could be a catalyst for that kind of trade?
Well, if Q1 or Q2 results show Vans' recovery is slower than hoped, particularly if that soft traffic piece doesn't improve, or if later in the year it becomes clear they can't fully offset the tariffs, or even just if the general consumer environment weakens further.
So it's basically a bet that the path ahead might be rockier than management's confident tone implies, at least over the next, say, 6 to 12 months.
That's the hypothetical thinking,
Yeah.
Again, purely speculative.
Okay, so let's wrap up this deep dive on VF Corp's earnings call. It really is a complex picture, isn't it?
It is. You've got clear, tangible progress on the operational side, gross margin, operating income, SG&A control, and real strides on debt reduction and the balance sheet.
But that's set against pretty significant revenue pressure. Some self-inflicted and strategic, like at Vans, but also some underlying softness there, too.
Right. Management, for their part, expressed a lot of confidence. Confidence in Reinvent, in the Vans plan, in handling tariffs and hitting those medium-term targets.
So here's the thought to leave you with, the listener, to mull over. They've kind of engineered revenue headwinds for the first half of this fiscal year with the Vans cleanup. Then the tariff headwinds are set to hit mostly in the second half.
How might the market react to that interplay? What happens if the Vans recovery in the back half isn't strong enough to offset those incoming tariff costs? Or what if either the Vans turnaround or the tariff mitigation doesn't proceed quite as smoothly as management hopes? Something definitely worth considering as you evaluate VFC's path forward.
That concludes our deep dive into VF Corporation's latest earnings. Thanks for tuning in.